Good afternoon and welcome to this webinar with Castings PLC hosted by Yellowstone Advisory. We're delighted to have with us today Adam Vicary, the CEO, and Steve Mant, the Finance Director. And I'd now like to hand over to Adam to start today's presentation.
Yeah, if we summarize where 24-25 was, that's pretty much in the first slide that you can see, slide 2. We saw volumes down about 20% during the year, which made it a pretty challenging year. Perhaps worse than that, the quarter by quarter, which I think is on slide 10, you'll see in a bit, things deteriorated quarter after quarter, which made life a bit of a challenge in terms of labour planning and so on and so forth. Q4 did pick up a little bit, and where we are at the moment, 2 months into the new financial year, we can see modest improvement over last year, probably 3 or 4%, something like that. The sort of summary of it is that the profit was pretty much in line with the market expectations. The final dividend was held, and we paid a small increase on the interim, so the full dividend was slightly higher. We've got the new line, which we'll talk about in a moment, the new production line, which is coming on really well, but I'll elaborate on that in a moment or two. And we have the plant, the new foundry plant in Scunthorpe. So we're very much positioned for a new growth phase in the company, which I'm sure will come through over the next few years. On to slide 3. If you're on that, Alex. Just some bullet points really about the sales volume and particularly tough markets in Europe and especially Germany, which we saw our German clients down a lot more than clients who weren't so focused on Germany. That has bounced back a little bit. Our main German customer is doing a lot better, quite pleasing, and we've just won some new business from them, so that's going a lot better. Our US business was very stable actually through 24-25 compared to 23-24 at around about 16.5 million. That was one shining light really in terms of volume. And that US business has continued. We are subject to tariffs. The tariffs for our products will be 10%. Thus far, that hasn't led to any loss of business, but there's certainly some uncertainty within the purchasing fraternity at our US customers because we haven't been converting recent inquiries into new business. So hopefully as time passes on and the tariff landscape becomes the norm, we'll start to see continued growth in the US market. Energy and the whole issue around energy pricing and surcharging and so on has been something of a challenge for the group for the last few years since the Ukraine invasion. We obviously surcharge all of our energy costs, and we saw energy costs start to decrease in the last financial year, and they'll decrease much more sharply in the current financial year. But we unfortunately had future forward hedges, which, as the volume dropped, we didn't require that amount of power, the electrical volume, but we had to pay up the hedges, which resulted in effectively a forward purchase of circa £1.5 million, which was very, very annoying. Some of that relates to this financial year, but we took the hit all in last financial year, so there are no further hits to come from that problem. In terms of the going around the group, the two main foundries found life quite tough with the lower volume. The machine shop, whilst their volume dropped pretty much in proportion, maintained a pretty good gross margin, actually the same gross margin as the year before, despite much lower volume. So quite pleased with the progress we've made in the machine shop. The castings ductile castings up in Scunthorpe. We basically purchased assets back in June. We re-employed people by July, and quite quickly tried to re-establish supply to customers who had been let down, and we turned a profit quite quickly, which was quite A, surprising, and B, somewhat rewarding for the effort we put in. But then we saw quite a drop off in demand, and the demand is pretty lumpy anyway through the winter and the spring. We put a sales force in place in the autumn, and it's quite pleased to report we are now seeing the fruits of that. And certainly from June onwards, the month we're in now, we are as busy as we've been since we acquired the assets, and pretty hopeful that the business will start to make a meaningful contribution to the group during this financial year. The new line is, in terms of the building of it, is well underway. Will be finished by the end of July, and then we'll be into the commissioning phase. It's going really well. I'm very pleased. The build quality is excellent, and it gives us an extra 12 to 15,000 tonnes of capacity going forward, of which we've already sold 3,000 tonnes, albeit some of that doesn't come on stream until 26, 27. And as we said earlier, we've maintained the dividend. So slides 4 and 5 show the new plant going in. Interesting, this was a week or so ago, and where my colleague is standing at the moment, you wouldn't be able to, because the rest of the plant is going in. It gives you an idea of the sort of size of the equipment and the plant, and it's going quite well. A bit about the plant: it's 12 to 15,000 tonnes of capacity, depending on how we work the shifts. It is a plant which gives us a slightly bigger envelope to work in, which opens up some markets that we were perhaps we weren't able to satisfy in the past. Certainly some larger truck brackets for electric trucks, some wind energy cable protection castings, and some agricultural parts, and some parts on off-road vehicles where they are typically a little bit bigger. And this plant has given us the opportunity to win that sort of work. So it's going okay. We've got off to a reasonable start on the sales side, and pretty confident over the next 2 or 3 years we will be utilising this asset more fully. In terms of castings ductile, or ductile castings as we call it, which is page 7, there's a bit more detail on what I've already reported. Castings up to 7 tonnes. A lot of the business is in power generation, Siemens Energy, Howden compressors. They're both associated with power generation. They're 2 of our larger customers. Quite pleased to report British Steel has come back to us for the first time since the Chinese were involved, and British Steel have placed quite a nice order with us through June and July, and we're hopeful that will become more of a base load for that for the business. And we've got a number of new customers have come on stream, maybe 20% or so compared to where we started, and some of the customers who we lost in the original startup have started to come back to us. So we're quite pleased with that. Nevertheless, it's been a painful 12 months. We've made losses operationally, and we've had to put some one-off costs in, particularly around foundry plant and equipment, where we've brought things up to date, and we're pretty well through that whole process now. There's a few bits have come into this financial year, but not a huge amount, and we're pretty much there with it now, and ready to take the business forward. We only operate at the moment at about 30% of capacity, so we've got a lot of capacity, so a lot of opportunity to grow in that business. The slide 8 is a sort of volume bridge, where you can see that the vast majority of the issues we had in terms of the operation of the business related to volume in the 12 months. We've not really lost any business. It's just the products that we make, the customers have taken fewer of them because they're building less trucks. And slide 9 illustrates that quite well. And we typically follow this particular slide. You see quite a drop off from the end of 23 into 24 and 25. But things do appear to have stabilised, and we are seeing small improvements in demand. I don't want to overplay it, maybe 3 or 4%. We can also see as we get into the autumn schedules that they are also a little bit better, but obviously we're not there yet. The quarterly sales graph, which is on slide 10, is quite interesting. It shows that we were down last year sort of 17%, then 20%, then 27%. So each quarter got worse, which the schedules weren't suggesting that, and clearly that was quite a challenge to manage. And then in Q4 we did see a slight improvement, and that's come through into this year. We kept all of the shift patterns in place, but we've reduced the headcount across the group by about 80 from some productivity initiatives that we fast tracked, and some tidying up in a few areas. Slide 11 gives you the European OEMs. We supply all of them except for Iveco, and you can see how they've all fared. Scania in particular was impacted 21 into 22 by semiconductors. They seem to have had more of a problem on supply of sourcing semiconductors than the likes of Volvo. But you can also see Mercedes drop off was quite severe into 2024, largely on the back of the exposure to the German market. So I'll just pass on to Steve to give you a bit more flavour on the financials.
Okay, thanks, Adam. Yeah, so set out on this slide some of the key sort of KPIs of current year compared to prior year. Obviously, we've talked about weak economic backdrop in Europe, heavy truck volumes down around about 20%. So group revenue of 177 million, which is a 21% decrease on the prior year. If you break that down, about 89–90% of that is due to the volume reduction, 17% due to energy surcharges reducing, an 8% increase due to the proportion of machined work, which generates a obviously higher price, which was kind of alluded to on Adam's revenue bridge slide earlier. Volume variations have a significant impact on the profitability of the group with the operational gearing that we have. So that 20% reduction really does impact the result for the year. Obviously, the opposite is true as well. So as we see a volume increase, then that profit comes back quite quickly. We've continued our progressive dividend policy by maintaining the final dividend. So that gives an overall increase on the total dividend for the year of just under 0.5%. Within the investment, about 11 million, just shy of 11 million, is in respect of the new foundry that Adam talked about, the Savelli line. There's about 5 million more to come on that, and that will flow through in the current financial year. And in terms of CapEx for the current year, we'd anticipate around the sort of 10-ish million to come through. If we then flick on to the next slide, we think this is quite a useful one to measure the performance. Obviously, volume-related performance reduction this year, but so it breaks down profit per tonne sold. When you're looking at revenue, there's lots of energy surcharges and other surcharges factored into that number. So it's quite difficult to gauge looking at margin because that's clearly impacted. So this just sets out profit per tonne. The blue line is the foundry businesses, and the orange line includes the machine shop as well. So it's the total group. So you can see the drop off in the current year, very similar to the sort of COVID impacted year of FY21. Also interesting, it kind of demonstrates the performance of the machine shop for people who've been following us for a while. The last 3 years, you see the orange line is ahead of the blue line, so the overall group result is better than the foundry result. There was a period between sort of FY18 and FY22 when the machine shop was loss-making and therefore was taking away from that overall group profit. So flicking on to the next slide. So this just sets out, I talked about progressive dividend policy. We do always look to at least maintain and increase if we can. So this gives a good sort of track record of the dividend over the last 25 years. So you can see every year we have had an increase bar the 2 COVID years where we maintain the dividend at the level it was. Next couple of slides just breaks down foundry performance and machining performance. So as you see, external revenue decreased 21% to 176 million in the foundry businesses. The weight of casting sold reflects that cyclicality that we talked about in the heavy truck sector, which has moved into a period of lower demand in FY25, having been particularly elevated in the previous year. The average selling price decrease reflects the greater proportion of machine parts sold, so that's pushing it up, but it's offset by the electricity surcharge reduction because we've seen those prices come down. So overall, the average selling price has dropped. So the overall result for the foundry segment was a 2.9 million profit compared to 16.2 in the prior year. The foundry result has been impacted by the 2 exceptional items. Firstly, Scunthorpe. We've seen a loss of 1.3 million in the period for that business. Obviously, it's just starting up. We have seen just shy of 500,000 of setup costs in that business as well. And then the other one is the 1.5 million that Adam talked about on the electricity related penalties that we've incurred for the lower volumes. So if you back those out, the adjusted margin would be 3.3 compared to 6.5 in the prior year. So flicking over onto slide 16, sets out the CNC performance and another solid machining performance really. Revenue down a little, external revenue down 400,000. That's, as we've said before, that the machining business is very much positioned to service the foundry customer base. So that external revenue line of between sort of 1 and 2 million is about where we'd expect it to be. So as a segmental result, 2 million compared to 3.7 in the prior year. As Adam mentioned, it's maintained its gross margin at around the 30% level. It's been helped by the investment we've done in the older machines and replacing those, which we've seen come through in lower repair costs in the year, but also that extra uptime because those maintenance guys are focused on keeping other bits of kit running. So EBITDA 6 million compared to 7.5 and slightly cash generative during the year. The capex of 3 million again is on replacement capacity, more efficient plant. And as we said, replacing that older kit, so seeing some real benefits from that. On the next slide, just sets out the cash flow for the year. Obviously, lower profit to start with, depreciation pretty similar. Working capital fairly flat this year. Capital expenditure much higher than the typical levels of sort of 4 to 5 million that we'd normally be running at. As mentioned before, 5 million of that is due to the new foundry line. And so overall capex will remain that bit higher in the current year, FY26, as that new foundry line comes to completion. Those who are not familiar with us, we do have a slightly odd arrangement with our pension schemes in that we pay the pensioners and the admin costs on behalf of the schemes and then recover it after the year end from the schemes. In this year, we've actually recovered that a little bit quicker. So that's why there's that pension inflow of 1.7. It's just to do with the admin of the scheme. It's not to do with the surplus and the wind up and that kind of thing. So overall, a net cash outflow of 17 million for the year off the back of that heavy capex and maintaining the dividend. I think it's back to Adam.
So a bit more about the business. We've are now considered to be or flagged as a green iron producer. That means that we don't use any virgin material. We are 100% renewable power supply, and we have a degree of our own power generation. That we have our first solar panel project producing about 1 megawatt of green electricity, if you like. The business is a complete process recycler, so we only melt scrap. We don't melt any virgin material, which we think over a period of time will give us a competitive advantage. So a lot of our competition, particularly in mainland Europe, is still using both virgin material and using coal products, i.e. metallurgical coke, to fire their furnaces. Slide 19, quite interesting. You can see we continue with automation. There was an amount of automation in the recent years capex, and the automated feed line cells, as we call them, which carry out the work that the operators would do, is now approaching 70, and we're continuing on that investment. So we're pretty much there on that particular area of automation. We've had a number of projects going with AI on metal treatment and inspection. I have to be honest that the technology isn't quite there for industrial applications yet. I kind of joke that it's good at cheating in exams and for people playing computer games, but when it comes to real life applications in industry, it's not quite there. But we're working on a number of projects anyway. Page 20 gives the customer mix, A, B, C, D. That's Scania, Volvo, Daimler, and DAF or Packard Group in that order. You can see we've seen reasonable amount of growth over the years with Daimler, because it was a new customer a few years ago. And although it was very challenging for Daimler last year, and hopefully they recover a bit more this year, which we've already started to see some signs of. And Volvo have also seen some improvements. So if we go to a sort of summarised outlook, which is slide 21, the truck demand has plateaued. If anything, it's a bit better, 3, 4, maybe 5%. It does appear to be a bit better still in the autumn, but we'll see when we get there. The new line and the plant in Scunthorpe is giving us cross-selling opportunities, which we've already capitalised on, particularly in the areas of the likes of wind energy and some agricultural products, which we have a very exciting new customer on board, which is just starting up now. The sort of headwinds remain with energy costs in the UK. Even after the falls that we're going to see this year, will still be 30-40% higher than Europe, and probably 5 times higher than the US. And labour costs, particularly this year, have been a real challenge. The minimum wage, we pay more than minimum wage, but nevertheless, it's kind of it's been set in a bit of a bar. And obviously, the NI increase has added significant costs. So there are some headwinds. It's not all positive stuff. So on the capex side, the new foundry will be finished in the summer. We've largely finished the machine replacement program. There'll probably be 1 or 2 a year after this year. And capex will settle back down in the 4 to 5 million range, with a degree focusing on continued automation and multi-manning of various machines to reduce the labour impact. In terms of electrification, the pace of implementation is very, very slow. But we are actually picking up a few new products on electric trucks, but the volumes are a few hundreds a year, as opposed to the tens of thousands on the diesel trucks. There's some development with biofuels and so on, but the technology remains a number of years ahead. And as it stands, we are seeing some opportunities on the electric truck side that we perhaps would have otherwise not have seen. And and the competitive position is a challenge, not least because of energy prices and the NI hike. And then on to page 22, we do feel that we're virtually through this rump of capex. We've maintained the dividend. If all else is equal and we carry on at this, even at this sort of lower level, cash levels will be restored, and we are in a very good position for growth, with plenty of capacity now on the upside of the cycle, and the ability to diversify into some of the markets. There is an appendix that follows for people who are really new to castings, and it gives you a bit of history if you wanted to go through that. I don't propose to go through that now, but please feel free to have a look at that. So that's pretty much it. I think we go to Q&A now.
Yes, yes, we do. We go to Q&A. Adam and Steve, thank you very much for that presentation. And just as a reminder, if you do want to ask a question, please type it into the Q&A box at the top of the screen, and we'll try and cover as many questions as we can. So let me start off with the first question. Can you explain how you manage your energy costs and energy hedges? What should we expect for energy costs in the current year, and are you expecting another electricity penalty cost?
I'll take that one. Yeah. Okay, so how do we manage electricity costs? If we go back a few years, we'd always look to manage it through having fixed contracts to give us the certainty and also give our customers the certainty, because as Adam mentioned before, it is a surcharged element. So that's how we typically do it. Our last fixed contract ended in October 22. Obviously, at that point, was at the height of the energy crisis, and fixed contracts just weren't available, or if they were, they were at such a high cost you just wouldn't touch them. So we went to a flex arrangement whereby we were predicting what we were intending to use and buying forward that energy consumption. We believed at the time that we had tolerance levels as part of that. Therefore, if we didn't need everything that we bought, we wouldn't be penalised for that. Clearly, that wasn't the case, and we ended up underusing by around about 20%, which is what has resulted in the penalty costs that we've seen this year. Going forward, so the new contract starts in October this year. We are buying. At the moment, we're hedging at around 50% of our expected consumption, and we'll increase that to around 75%, and then maybe close to 100 as we approach the period of use, i.e. trying to remove that penalty element that we've had this time round, but at the same time trying to balance that with taking risk off the table, in that prices might spike on something that we haven't hedged. So that hopefully that explains how we do it and why we do it, how we do it. In terms of energy costs for this year, we do see a reduction coming through this year because of the rates that we've contracted for, and it's probably around about the 6 to 8 million mark that we'll see a reduction of energy costs in the current year. As we say, they are surcharged, so that flows through to a reduction in the selling price as well. In terms of penalty costs for this year, no, we've provided for that at the end of last financial year. So there's about £650,000 provision of that 1.5 was relating to the year we're in now. So that just gets released against that higher cost.
Thank you, Steve. Next question here. Why are you investing in capacity when volumes or demand has fallen so much?
Okay, I mean the when is the right time to invest? Obviously we saw in 23-24 was a record year for the company. We've been going since 1835, and we were over busy. And in certainly my time in the business was 15 years. Every time we have a peak of the cycle, we don't have enough capacity, and we end up under significant stress, and we run the risk of losing business. So the first thinking is we need to have some more headroom when the cycle is at its peak to be able to manage without stressing the business. Secondly, we are a foundry business. At the end of the day, that's what we do. That's what we are believe we are experts in. We should be investing in new foundry technology, in our opinion, and that's the second reason. The third reason is that we would very much like to. Well, first of all, we'd say the market we're in is heavy truck, and it's been good to us. It's been good to the company. It's been good to the shareholders. It's been good to the employees. But it is cyclical, and we'd very much like to be able to find some counter-cyclical work, or at least some work which is outside of the heavy truck sector. The problem we have is that when the truck sector is busy, we don't have the capacity to go and find that work, so we typically don't do it. So we found ourselves somewhat stuck, but a new line gives us the opportunity to start looking in these other areas and to bring in some new business whilst maintaining our current heavy truck business. So such that heavy truck at the minute is 75%. Ideally, and this is a sort of ideal scenario, in 3 to 5 years' time, perhaps heavy truck is 65%, but still growing. So hopefully that answers the question.
Yes, thank you, Adam. One last question, and just as a reminder, if you do want to ask a question, please type it into that Q&A box. But we've got one last question that's come in here, and let me ask it. When are you expecting Castings Ductile to be profitable, and what needs to be done to achieve this?
Slide. Yeah, I mean, it's a business with very, very lumpy demand, and what it needs is a degree of background work to cover the overheads. We think we're very close with that. To answer the first part of the question, when do you think it'll be profitable? Well, we think June this month will be profitable. April and May will have made some small management account losses, but we expect from June onwards it will be profitable. That's on the back of some quite nice orders that we've had, not least British Steel. Have we got enough of a base load yet? I'm not too sure, but we're definitely getting more of a base load, and that's what we need to cover the overheads. But I think we're getting much closer. We've got a very nice opportunity that's presented itself in the last few months as well that we're working hard on, and hopefully we can pull that off. So what do we need? We need a good base load, and when do we like to see profitability? We think fairly soon.
Fantastic. Look, there are no further open questions at the moment. So let me thank you, Adam and Steve, for presenting so clearly on the Castings full year results and the outlook going forward. Thank you to everyone for attending. And just to remind you, as you do exit today's webinar, there are a couple of short questions to ask in terms of giving feedback to the management team here, and really appreciate it if you could just spend a couple of moments completing those questions. So look, thank you very much for attending, and we look forward to seeing you soon.
Thank you.
Thanks.